Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Thanks, Ashley. Good afternoon, everyone. My name is Evan Bradley. I am the CFO here at Campbell Property Management and one of the 5 partners of the company. I'm also a licensed CAM, and I work very closely with some of our largest clients on the major issues facing their associations. And unfortunately, this year, for many of you, that is budgets, and a huge component of the budget for those of you who live in a condo is the insurance. So we have been facing this and dealing with it quite consistently this year. For those of you who may not be familiar with Campbell, the company, we've been in business since 1953. We manage over 400 HOA and condominium association clients in Dade, Broward, Palm Beach, Martin, and St. Lucie counties. Our guest speakers today to help us understand the state of the insurance market are Paul Mack and Chad Tiernan of Assured Partners. So, Paul, would you like to introduce yourself and your firm a little bit?
Thanks, Evan, for having me back. Really appreciate being here. Assured Partners, we write about 3,000 communities throughout the state of Florida, this is our specialty. We've been in business since 1989, and again, great to be back here. Really appreciate the opportunity.
Thanks, Paul. So just a couple of housekeeping items. This is for informational purposes only today. This is not legal or property management advice for your specific association. If you need insurance management or legal advice, please do reach out to the professionals that you have hired at your association. And as far as questions go today, please try to limit them to the course material that we are presenting. Very specific questions about your unique circumstances are going to be beyond the scope of what we're able to answer. That being said, I do encourage you to use the Q&A. We will be monitoring it, and we will try to answer questions throughout the presentation and for sure at the end, so don't hesitate to get your questions in. All right, so what's on our agenda today? We're going to cover the basics of association insurance first. How does it work? How do you get bids? How do you know that you're getting a good deal? Those sort of things. I know those are very top of mind to those who registered. We're going to talk about the state of the market and see if there's any relief potentially on the horizon. Roof age and mandatory replacement has really exploded as a hot topic over the last 12 to 18 months since we did the last one of these. We were just starting to see it at the end of last year, and it really has been a huge issue all through 2023. What to expect for the end of 23 and going into 24. What, if anything, can be done to reduce your rates, and how to communicate. So let's jump into it. So, Paul, the basics of insurance. So what insurance must the association carry? And this is the most I've ever heard this question is this year, and I never heard it in my career ever before, which is, can we self-insure?
Yep, that has become a question that we're fielding on a regular basis now, and obviously because costs are so high and boards are frustrated, so they're trying to be as diligent as they can and find any possible solution. But so the basics of insurance: every association carries a property insurance policy to cover windstorm, fire, and lightning. For the improvements in the community, whether it's a condo or an HOA, the buildings. If it's an HOA, there's improvements like clubhouses and signage and fountains and things like that. So all of that is covered by a property insurance policy. And then we have third-party liability policies for slip and fall. Very common to see slip and falls occur all the time, where somebody is suing the association or claiming that they got injured because of the association's negligence. We also see associations carry directors and officers insurance, liability insurance. So that, in its simple definition, is management malpractice. The board is making decisions, acting in a fiduciary obligation to spend the money like it's their own, and someone can allege that they made a bad decision and it's affected the values, or it's affected a unit owner, and they bring a claim. We also have excess liability. So these slip and fall and these management liability policies usually end at $1 million when you buy a primary insurance policy. So that's really not enough in today's very litigious world. So we see associations carry umbrella or excess for up to $25-50 million because it's relatively inexpensive if you qualify for that. And there's some other policies such as equipment breakdown coverage. It covers sudden and accidental mechanical breakdown of anything that's mechanical. We also have crime insurance, or sometimes known as fidelity insurance, and it covers all those association funds that are financial instruments, whether it's cash in the bank or a conservative investment like a CD, if that money is stolen or a third party hacks into it.
So, and then let's talk about the self-insurance for a minute, because that's a very popular topic. Can condos self-insure?
Well, it comes up a lot. It's not very practical. I would say that some associations are more forced to go bare on insurance than self-insurance, because self-insurance is a real process. If you look at a company like General Motors or Coca-Cola that are self-insured or have very high retentions, it's a process they go through. They're looking at their claims. They're predicting what their losses are. They're hiring consultants and third-party administrators to help them with the handling of these claims and proper funding of these claims. So the reason it's not very advantageous are a couple things. Number one, that most of the associations are some of the unit owners in there are having to get mortgages in order to buy a unit, and a bank is not going to accept self-insurance or really no insurance. So it would present a problem with some mortgages that are in there. The bylaws require that the association buy insurance, and the other impractical part of it is, there's a big exposure. There's a great amount of real property or assets that are exposed to a catastrophic loss of windstorm. So if there was a loss that occurred and the association didn't have insurance, the directors that are making the decision to not buy insurance could be held liable for that decision, and that's a great risk to those individual directors.
Right. So what a lot of people ask, how do I get bids? Can I get multiple bids? Can I have multiple agents bid? It's a very, we already have 2 questions in the Q&A around this. So can you help us understand what is the role of the agent and how does insurance actually get bid out?
Yeah. So, this is a real good topic to cover, because this comes up all the time, and insurance is so much different than getting bids for, say, roofs or paving or anything like that, and boards want to be diligent. They want to go out and they want to shop. So I think the most misunderstood part about this is, and this agent of record that we hear so much about, insurance companies in general only deal with one insurance agent at a time. So sometimes that gets perceived by a community or a board as, well, these companies won't bid, or it's a monopoly. But that's not really how it works. The insurance company is gonna model the risk. They're going to take the data that the insurance agent has provided, and they're going to give a quote. They don't want to be giving multiple quotes to multiple agents because they don't want to be duplicating work. And the theory is that, look, their rates are going to be the same, okay? But what's important for communities to know is the person or the agent who's kind of quarterbacking this or masterminding this has a lot of control. How the data is presented, who it's presented. Is it presented to all the companies that are out there? So what I think is a great way to go about this is, before you engage an insurance agent, it's a good idea to interview multiple insurance agents and get some ideas of what this agent, he or she, can do for your community. For example, is the insurance agent a specialist in writing community associations? Do they know who the carriers are? Do they understand how to present the data? And do they know the right coverages that an association needs. So I think that's a critical part of this. And when it gets misunderstood that, well, we can only get one bid from one agent, you're not locked into any agent. But it's important that associations understand that before they sign an agent of record, sometimes an agent will either mislead or miscommunicate the fact that an agent of record is the association making a commitment to an insurance agent by removing the insurance agent who's on there now and engaging the other agent, and they think they're just getting a bid. So you're not doing that. And by all means, they should talk to other insurance agents and get opinions. But if somebody's saying, hey, I'm just going to save you money and I need this agent of record to get a bid, I would be very, very cautious of that.
Yeah. So how do they know? I mean, so if you have to work with one agent, you've interviewed them, they've prepared proposals for you for insurance. How do you know that you're getting the best deal as an educated insurance consumer?
Well, I think there's a good deal of trust that goes into the relationship with an insurance agent. But having said that, you can also, I mean, a good insurance agent is going to prepare a renewal proposal. A good insurance agent is going to show their client where they've gone, who the carriers that they've approached, and what those carriers have done. We try and be very transparent with the process. So, oftentimes we hear that the association has been backed into a corner the day before the renewal. The insurance agent comes in, hands them a big increase without any warning, and kind of says, hey, this is your option. There's nobody else out there. You got to sign this, and I need a check before the end of the day. Well, I don't think that's very transparent. We like to, and I think other agents do the same thing, where we'll lay out a timeline. So this is what the client can expect, and this is when the client can expect it. And when we present a renewal proposal, you'll see who was approached. And I think there's a good deal of information that it gets exchanged with the client about how we go about presenting the data. Mitigation forms, the modeling, the updates that have been done in the building. It's important to present that data to the insurance companies in a way that's going to produce the best outcome for the client, because the market is so tough right now.
Right. Yeah, and I've actually seen some of your proposals for our clients and from some of the other condo and HOA specialists, and you do a good job of showing all the different carriers and whether they declined to bid, or if they did bid, what their number was. And it's very eye-opening, A, in this market, how many declines you're getting, and B, just the wide range of pricing that's out there if you do get multiple high. Some of them can be. So admitted and non-admitted are terms that we hear tossed around all the time when talking about insurance companies. And I don't know that everyone really understands what that means. Can you help us understand the difference between admitted and non-admitted carriers here in Florida?
Sure. So two big differences between an admitted carrier and a non-admitted carrier. The first difference is the fact that admitted carriers are going to be subject to a higher degree of regulation from the Florida Department of Insurance. So what I mean by that is admitted carriers have to file their forms. So they can't write an insurance policy without all the forms and endorsements being approved by the Department of Insurance. Not to say that non-admitted carriers are bad, because in this market, we'll take any capacity we can get. And that is a critical role of an insurance agent, is to vet these insurance policies and make sure that what the consumer is getting is what they expect. But the other big difference is the guarantee fund. So an admitted carrier, God forbid, goes bankrupt, because we had 8 go bankrupt in the last 18 months. The admitted carriers carry the protection of what's called FIGA. That stands for the Florida Insurance Guarantee Association, and the FIGA will cover unearned premiums as well as unpaid claims. So you have a financial security there with the admitted carriers. In this market, the way it is, I don't think any carrier is discounted, but having a choice when you have 2 options on the table, you're going to lean towards an admitted carrier most of the time.
Thanks. So this one we had covered. So state of the market. I think again this year, even though it's been maybe 2 or 3 years now, we're still seeing substantial double-digit increases on renewals throughout 23 and Q1 24. What is driving this that we're now on our third year of these large increases?
Yeah, and in 2023, it really took the steepest increase that we've seen in the 3 years that we've seen this. But several factors. I gotta say, I mean, we've talked about this before, but the legislative environment, the regulatory environment in Florida has been really bad. Some years ago, lawmakers, in an effort to keep insurance companies accountable to consumers, I think the effort was there, the intention was good, but Florida decided that if you were going to sue your insurance company, the insurance company had to pay both sides legal fees. And again, in an effort to keep them accountable and try and have them handle claims in good faith, they did this, and it backfired because 80%, 85% of the lawsuits come from Florida when you sue your insurance company, but only 13% of the actual claims came from Florida. And that really sent things spiraling downhill. The other problem that we had was from 05 to 17, we had no storms. Rates became a very competitive market. Rates got too cheap for too long, and it wasn't sustainable at the rates that carriers were writing business at. Mm-hmm. So we had to get it to a sustainable level. We saw this influx of lawsuits, and Florida became a very, very bad marketplace. And then at the same time, we're looking at the Surfside building collapse, a very increased underwriting where, it was really simple to go through underwriting, became super hard. And we'll get into talking about, proper valuation. But all of these things that we're talking about are compounding the cost of insurance in Florida.
Right. So did Hurricane Ian impact the market the same way that Irma did, or has it not been as big of an impact?
Yeah, I mean, it hits the whole state. The lawsuits that I had mentioned to you, where they were what we call in the industry one-way legal fees, all of those claims that came from Ian are still grandfathered into that. So, it is having a bad. I mean, I guess where we saw with Irma and some of the other claims, it can't get a whole lot worse. I mean, we're seeing 100% increases, 300% increases. So I think it's a lagging effect of all the things we just talked about. But certainly having those storms, having that storm with as big as it was hitting a populated area has had a negative impact.
Right. And now, we're obviously dealing with inflation. So not only do we have the legal issues in Florida and the storms that have hit the state, but the inflation of replacement values. So how's that impacting premiums?
So it's not only the inflation of replacement values, but I would say it is also the gross undervaluation that has gone on for the last 10 years. Insurance companies have been claiming that, hey, these are not real valuations. And remember, when we buy property insurance, the rate is a component of the valuation. So the rate that applies is per $1,000 of insurance that you buy. So if the property isn't insured to the full replacement cost, it's only insured 70% or 60% to the true replacement cost, and the insurance company is losing out on 30 to 40% of the cost of that. So for years, insurance companies said, these valuations are not right. But because things were so competitive, they weren't really in a position to say, we're going to increase your values. And it just kind of went on. And then when Surfside occurred and all of these things started to occur at the same time, where the one-way legal fees, we started seeing an increase in storms, rates were inadequate. So it became, and it still is, the number one thing that underwriters are looking at proper valuation. And unfortunately, most communities, even if you did an appraisal, you weren't looking at a realistic number. So now you're having to update your insurance appraisal. You're seeing a 20, 30, 40% increase in the valuation, and you're seeing a 20, 30, 40% increase in rates. So this is why we're seeing such a large increase. And, even if you don't do an appraisal, you're not going to hide from this, because the insurance company is going to, as part of underwriting, is they're going to look at the replacement valuation, and they do that based on a cost per square foot, which goes back to having the right insurance agent. Sometimes we see these appraisals and the data's wrong. They'll take the catwalks and they'll make that square footage, and the insurance company says, well, this square foot per price is too low, and it's wrong data. So but they're looking at that information, and if that data is not right and they think it's too low, then they'll just make it up in the rate. So valuation is important, and not doing an appraisal or trying to artificially lower that because you think you're going to get a lower rate is not going to help you. And that's where the value of a good insurance agent to help advise you is key.
Right. So there was some new legislation back in July regarding tort reform and trying to rein in some of the issues that the property insurers had with the one-way legal fees. Are you seeing that helping at all, or do you predict that to help some more in the future?
Well, I'll tell you this: why it's been widely stated that not enough was done, but to the defense of lawmakers in Tallahassee, to pass this kind of legislation that negatively affects their constituents is a tall order. They had to do something because this is a crisis. So they kind of put a tourniquet on the one-way legal fees, but it only applies to admitted carriers. So we just talked about the difference between admitted and not admitted, and there's a big market of non-admitted carriers that are still subject to these one-way legal fees. So it's going to help. It's going to be slow. We haven't seen a noticeable difference because specifically of the legislation. I think if I'm going to be optimistic here for a minute, I'm going to say that I'm hoping that 2024 we're going to see the apex of this horrendous market, and I think things will start to slowly level off. And I do think the recovery of rates and capacity and terms is going to be a slow recovery, but I am optimistic that in 2024 we are going to start to see an improvement.
All right. And we've talked a lot about property insurance. It is typically the most expensive for the condos, but we do definitely have some HOA people on today. So what can you tell us about the other lines of coverage that may be a larger percentage of the insurance costs for our HOAs, like liability, D&O, and the umbrella and excess?
Yeah, they're so important parts of an insurance program for a community, and because property insurance is such a big cost component, it becomes overshadowed. But a D&O, directors and officers liability claim, management malpractice, it's relatively cheap. But that market has had its challenges. But there's still, compared to the property, there's still a lot of carriers that are in the market. South Florida, I would say, is harder than other parts of the state, but having an agent that understands how to write community associations and knows where to source this is really important. You want to have a policy that is geared specifically towards community associations.
Right.
And then, general liability has seen tremendous challenges in South Florida, primarily because of the inflationary factors that going into settling claims, something called social inflation. And basically social inflation is the increased cost to settle claims. So a slip and fall claim that historically settled for $30,000-$40,000 is now six figures. It's now over $100,000. Plaintiff lawyers know this, and they're driving higher settlements. And this is all a factor of rates So we're seeing carriers leave the market because they can't make money here. We're seeing pressure. We're seeing a lot of these policies migrate to the non-admitted side, where you carefully have to vet these policies for exclusions, which we'll talk about. And in the wake of Surfside, the umbrella and excess liability market we've seen a big contraction of that, because historically it's been really, really inexpensive to go out there and acquire, 15, 25 million, $50 million for a community. And they buy it because it's really good value. Now those carriers have really hardened their qualifications. And if you have open claims or you have a high percentage of rental units, you don't qualify. And now those excess or those umbrella policies are becoming very costly.
Right. Yeah, and you mentioned exclusions, and we've seen a huge rise in this. It's another way that insurance companies are trying to effectively reduce coverage by just not covering things they used to cover. And I think it's really important that boards be aware of these, because you may have the same carrier you had last year, but they may have added something in the fine print, and you do not have the same coverage that you had last year. So let's talk about, Paul, what are some of the most common things that are being excluded, and why are these so important to not be excluded?
Right. You hit the nail on the head when you said you might have the same provider. They might even raise the rate and throw these exclusions on there. Sometimes it's as simple, for example, where, concerning exclusions here, you're the animal bite. Sometimes it's as simple as showing, because one of our key providers of liability, and they have a good policy. It's kind of their standard operating procedures that they offer a quote, whether it be for new or renewal, and they put an animal bite exclusion on there. Now, we can overcome that if we show them the association's policy on pets, and if there's if there's a restriction on size and things like that, we can negotiate this very effectively. In some cases, no increase in cost. It's just because we know to go and ask for that. But there are some carriers that have a hard no on animal bite. And, if you look at the statistics, Florida, Texas, California have the highest percentage of animal bite lawsuits in the country. So carriers know this, with the availability of data that's out there today, insurance companies are smarter than they've ever been. So they look at this information and they underwrite accordingly. And it's important that if we can't get an alternative, at least it exists. But as a role of an insurance agent, I'm going to go out there and try and find the best policy I can for the best price, and try and help my community make the best buying decision that they can. But these exclusions exist. So anything that, where a dog is gets off the leash or just bites a resident or a guest, and even if it's, we know that the dog owner is responsible, but in this world, the association is always going to get sued. So you have that exclusion on there, you get it, you get a demand, you get a claim, you get a lawsuit. The insurance company says, sorry, we're not covering you, which presents a big risk to the association, because now they got to come out of pocket to defend themselves and settle this.
Right. Yeah, we're seeing a lot of those type of lawsuits, and the reason some of these things are being excluded is because they are extremely common, and that if you don't have insurance for something that is a very common occurrence here, you're like Paul said, you're flying naked, and it's very dangerous, and you may end up having to assess the owners for either defense costs or potentially any settlement costs.
Yeah. And with the data that they have, some of these carriers are very firm on not providing some of these coverages, like assault and battery is key. I mean, think about that. Any kind of violent act that occurs where, these lawyers are going to look for a deep pocket. So if something happens on the property, they're going to allege that the lighting wasn't good and the association contributed to the loss, because they want the insurance company to come to the table and write a check. And these assault and battery exclusions or limitations significantly reduce the coverage that a community has. So when you're looking at alternatives, because the cost is so high, you can't be penny wise and dollar foolish here. And sometimes it's not always disclosed. The carrier will say, oh, the limits are the same, the coverage is the same, but that stuff is buried in the fine print. And, having a relationship of trust and understanding, because very few consumers are actually going to read these proposals and policies where they can find this. Not that you shouldn't, but that's one of the greatest values of the agent, is being able to help navigate a community through this.
Right. And you had mentioned other warrants. That was actually a term I wasn't even that familiar with till recently. So could you explain for everyone what other warrants are besides the exclusions?
So a warrant in an insurance policy is a condition that must exist in order for the insurance company to pay. It's kind of like, we're not going to cover you unless you do this. For example, we often see that there are safety requirements. So they'll say, well, your pool has to have a ring, and it has to have a self-latching gate that is in working order. And most communities will have all those things because they're code. But if at the time of a claim, the pool fence wasn't in working order, this gives the carrier the ability to wiggle out of paying a claim. Mm-hmm. So you got to be aware of these warrants, and sometimes we can negotiate them out, and sometimes we can't. Another common warrant is dealing with vendors. The association should always be diligent about making sure that vendors are insured and that they show certificates of insurance. But sometimes the insurance companies take it a step further, and they say, not only are you going to have to get proof of insurance, but now you have to have sophisticated risk management language and indemnification language in there that if you don't know it exists, you're never going to comply. So you got to be aware of what these warrants are and how they affect your insurance.
All right. So the next slide, this might have been the hottest topic in insurance in 2023, roof age and mandatory in-place replacement. So why do insurance companies all of a sudden care so much about how old the roof is? Because it didn't really seem to matter before this year.
Yeah. Definitely a heightened emphasis on this topic for sure. So I guess the first thing I want to say is, I think the most misunderstood thing here is, because constantly I get asked, this is a perfectly good roof, why are we having to replace it? There's a difference between a roof that doesn't leak and a roof that's beyond its useful life. Okay, a lot of this goes back to what happened with the one-way attorney fees. So insurance companies were backed into a corner because they got sued by the policyholder, and they got forced to put a new roof on, but the roof was beyond its useful life. So the carrier couldn't show that, well, the roof was old to begin with. So since we have very little capacity out there, carriers have said, if these roofs are old, we don't want to write it, because it presents a higher exposure to us that we don't want. So all of those buildings that had newer roofs, found it a little easier to get insurance, and all those buildings that had older roofs found themselves getting declined by Citizens. A lot of people think that Citizens is there because they're the state and they're what we call a residual market. They have to take you. Not the case. You have to pass their underwriting, and I'll tell you this, I'd say that their underwriting is more rigorous than some of the private carriers that are out there.
So I think you kind of covered this, but we're seeing them too. A lot of declines, just straight up declines due to roof age.
Right.
Some people are saying, can we get someone to write a report to at least get us through this year and get us some coverage? Are you seeing that work?
Yeah, we do see, roof inspections are a critical piece of underwriting data that carriers want to see. In fact, Citizens won't even consider your application unless you present them a roof inspection that is generally presented on their form, and they will gauge the remaining useful life of the roof. Citizens has the ability to decline a submission if it's within 5 years of the end of its useful life. And one of the biggest challenges is dealing with Citizens, and in some cases, Citizens can offer at least a cost alternative that is somewhat attractive because there's no market out there. But if they turn you down, there's no consistency, is what we're seeing there, because underwriters have a good deal of discretion. They're grossly understaffed for the amount of submissions that they're handling, and the way that they go about doing business. It doesn't make sense for the way they're doing it, but that's a whole nother issue. But we'll see one association that has 3 years useful life get approved and one that has 4 get declined. And how is that? Because that's discretionary decision by an underwriter.
So if someone does get a cancellation, well, let me back up. Are you seeing cancellation notices come out for in-service, policies that are currently in service due to roof age?
Yes. Oh yeah.
We're seeing
that. Sorry, Evan.
I said, and that's scary because you think you have insurance and then 30 days from now you don't. So what do you suggest to your clients that end up in that situation?
Yeah. So a couple things, like some carriers, because again, I've said this before, technology, these carriers are pretty smart. They can use satellite imagery, they can use AI, and they can go through their books of business, and technology can tell them these are the ones you want to pay closer attention to. And we've seen carriers come flat out and say, we've reviewed this, we're getting off, we're canceling you, we're not giving you an option. One of our big carriers that writes a ton of business, mostly condos in South Florida, all over the state, they'll renew you, and then they'll go in within 30 days and say, okay, we want to see roof maintenance. We're going to start to underwrite this. So I think documentation is key to make sure these roofs are being maintained. In some cases, when you are at the end of useful life, we're seeing this, and I know you are too, where the community is looking to have to re-roof because they're not able to get insurance if they don't.
Yeah.
But that's what we're faced with right now. I can't tell you how many communities right now are re-roofing because if they don't, they either won't be able to get wind insurance, or the cost is just so outrageous that they're forced to do this.
Right. So I think we covered some of this, but what are we going to see in 2024 and beyond, and especially around kind of percentage increases? There's a lot of people asking, well, what percentage increase should I budget for next year? What should I expect?
Yeah, well, I'm optimistic. I'm optimistic that we've seen the worst. Maybe the first half of 2024 is going to be more of the same, but I'm hoping that maybe third quarter things are going to improve. I am starting to see signs of some new capacity coming into the market, and I think the key indicators there are a couple different things, right? What do you budget, or what do you see percentage wise coming up? I think you got to look at where your current rate is. You gotta do an analysis. You take the amount of insurance that you're buying, divide it by the premium to come up with the cost per $1,000 of value that you buy, and gauge that to the market. Any good insurance agent that does community association business can help you there. So if that's under the market, that will give you a pretty good idea of maybe what you could expect. Okay. Then I think some other factors are you due for evaluation appraisal. So if your 3 years is up and now you're gonna have to do a new valuation, that's going to compound your increase. So you've got to look to see if that's going to play a factor. But the optimistic part I'm at, where I'm seeing a lot of these rates that are reaching what the insurance companies view as rate adequacy. And rate adequacy in simple terms is, hey, at this dollar amount, we think we could sustain here and we can make money. Because Florida, is a growing state. From a marketing standpoint, it's very attractive to be here, right? We're one of the fastest growing states in the country. So it does present an opportunity if they can get enough money to take the risk. And because rates were so low for so long, that gap has been huge. and most communities are there now. There aren't that many that are taking advantage of a artificially low rate and that have slid by. We're just not seeing that anymore.
You had mentioned wind sublimits or something that's kind of popped up this year. What does that mean, and how does that work?
Yeah. So let's take a community that is going to have to get insurance through a non-admitted carrier because an admitted carrier either turned them down or non-renewed them, and Citizens is not an option. And let's take a community that has 500 units and has approximately just to keep the numbers around $100 million of insurance in buildings that they need to insure. That's the amount of the insurance that they need to buy. For them to go out in the private market and acquire $100 million of windstorm insurance, we're not going to find one carrier like Citizens or like American Coastal that has traditionally been doing this because it's just too much risk. So they're going to buy what we call a layered program or a tower. We're going to find a company to do the first 10 million, and then we're going to try and find another company to maybe do 10 over the 10, and we're going to layer this up. If I have to layer this thing up to $100 million, the cost is going to be in the millions, and it's just not affordable. So what some communities are the best option for them is to buy some windstorm insurance, but not the full amount of the replacement cost. A, because it may not even be available, and two, is it's just simply cost prohibitive. So we help associations make the very best decision that they can, given the circumstances that they're in. But these sublimits are becoming more and more popular because they're giving us options. They're giving us cost relief if we need it, and we're not completely naked on insurance. We've got some coverage for windstorm. Those for many associations. I mean, that really kind of surfaced this year just because of the limitation of capacity that was out there. But in the 30 years I've been doing this, it's never been an issue before. And I'm hoping that we're going to see some more of those sublimits become available, where those primary layers that go for the most money, we'll see more capacity there. And when there's more capacity, hopefully there's competition. Perhaps, an association can either save the money, buy less limits, or, for the same money, buy a higher sublimit.
All right. And then we talked about this last year, and I think you're seeing it again, is co-insurance. And we'll go through an example, but the co-insurance provision, that's a result of what you had said earlier. So many of these buildings were underinsured from a replacement value standpoint, right?
Yes.
So why don't you take us through, it's a little bit dense, but I do think it's important for people to try to understand how does co-insurance work in the event of a loss?
So co-insurance is a tool that the insurance carrier uses to protect themselves because I mentioned earlier on that the cost that the insurance company, the rate is per $1,000 of valuation that a consumer buys. So the consumer decides how much to buy. So if, let's just keep the number simple, the replacement value of a building is $10 million, and the policyholder, the association, says, well, that building's worth $7 million, not 10, or they decide to buy a $7 million. They have an appraisal. It's an old appraisal. It's not, at the current proper replacement valuation for whatever reason. So the rubber meets the road when there's a claim, because the insurance company does their own appraisal. And if the value is 10 million and the insurance is 7 million, in simple terms, it's about 30% underinsured, right? So when they present a claim to the insurance company, whether it be for 100,000 or $1 million, the insurance company is going to invoke that penalty of what they should have insured over what they did insure. And, it's going to be that penalty is coming off the claim. Right. So it protects them. Hey, what they're saying is, if you're not going to pay us enough premium for us to collect enough money to take the risk, then we're just going to take it off the claim when it comes time for you to present a claim.
Right. Okay. So everyone's favorite question, how can we try to reduce our rates, or at least reduce our increases? And I think one thing I have seen some buildings do, particularly some beachfront buildings that we manage, is some improvements to the building, particularly around windows and doors. Can you talk about that a little bit?
Yep. I mean, basically, it's really hard to put a specific number. I get asked all the time, "Hey, if we replace the roof, how much are we going to save? Hey, if we retrofit the doors and windows and impact glass, how much does that save us?" I can tell you that when it comes to available capacity, that those carriers that are in the market are going to look at the newer roof buildings, the ones that have updates, the ones that have impact glass. You're going to qualify for whatever capacity there is out there, and if you can qualify for that capacity, you're going to be taking advantage of the best rates that are on the market. For some associations, that's going to mean that the increase that they're getting this year is less than what it would have been. That's probably a common expectation of what you can see with this. I can tell you it's not just those two things that we talked about, roof and doors and windows. It's electrical panels. Big issue right now are these Federal Pacific panels, these INSCO panels that are fire hazards. So it's a hard no. And if you have them, you're going to get declined maybe by some really good capacity otherwise. So we're seeing a lot of communities that are now having to, in addition to replacing the roof and maybe retrofitting the windows, now they're having to do some serious electrical equipment retrofitting, which is significantly expensive. But that's a big factor, is qualifying for the capacity. And that's going to be different for every community. But having an agent that can help you dial in on the specific criteria to help you take advantage of whatever capacity is out there is gonna have a direct impact on your cost.
All right. Yeah, the biggest one that we've seen some condos actually accomplish is the complete replacement of all windows with impact glass, both common areas and for the residence windows. But they all have to be done. You can't have any one unit left over that still has the old non-impact to take advantage of the better pricing. But it can be very hard to convince the owners to do that. And some associations have had success working with their attorneys to actually try to force owners, if there's a few holdouts left, keeping the building from being fully impact glass, and actually getting that accomplished through using the association's counsel. The other thing that we see that, when you have an open claim, as you've mentioned many times, particularly on the liability side, that really drives that rate up on renewal and leads to cancellations. So we really encourage you to be walking your properties and making sure they're safe. Sidewalk claims are just a massive issue right now. If you have sidewalks in your community, which almost everyone does, you really need to be on an annual or maybe even biannual maintenance plan to try to address that, because you may not have a claim today, but if you have one tomorrow, your renewal is going up substantially. So there's some things management.
That's a great point, Evan. We've helped associations set up safety committees, and with some bigger communities where they literally have a committee, and we'll help them kind of set parameters for what to look for to help have an impact on their performance, because that's a big factor of what your premium is going to be, is your individual past performance, your loss history over the 5 years. So if you can tell the underwriter a story of why it's going to get better, that's going to help.
Right. So I don't want to get too deep into the weeds on the legislation piece. But like we talked about, the state did try to address this. We're not sure that it's enough. Hopefully these one-way attorney's fees and some of the very questionable roof replacements that were happening, where guys were going door to door throughout an entire community telling everyone they were entitled to a new roof. Hopefully some of the stuff has been reduced by the legislation, and then that has a trickle-down effect of impacting the rates. But I think we need more time to see if that's reality or not.
And it's important to know, one of the things they did was reduce the time that you had to file a claim. So, that used to be 3 years after a hurricane, and then it sunset. Now that's gotten reduced substantially, twice legislatively. So you've got to report a claim immediately when you have a claim, because what happens is hey, we don't have any damage, and then somebody convinces the association to file a claim because they got nothing to lose.
Yeah. So how do you communicate these insurance increases to your residents? You got to do it early and you got to do it often. This is not the first year of this, so I think people are unfortunately becoming somewhat accustomed to these big increases, but it is still very painful for so many of the association members. So the more lead time you can give people on the increases to your budget, the better. Don't be afraid to have your professionals deliver the news the way Paul has done today. I've seen him do similar things for associations at their meetings on Zoom, and educate the owners on what's happening in the market, what's happening at your specific association, and why those rates have gone up, and answer any questions that people have, rather than you have to try to ask him and then regurgitate it to the community. Let the professionals answer the questions directly. And do keep in mind, condo insurance is still a good deal. If you live in a waterfront unit and you're paying $1,500 to $2,500 per unit for insurance, it's a lot of money. It's a lot more than you might have paid a few years ago. But if you were in a single family home with a waterfront view, you're probably closer to $7,500 to $12,000 for the same square footage for your insurance package. So just keep in mind, it is still community living is still a very good deal over what it would cost to have the same location in a single family home. At this point, we got about 8-10 minutes left, so we do have a bunch of questions. Paul, I'll try to moderate these and give you the ones that I think will be the most beneficial for our group today. I don't know that we can get all of them. Let me just see here. So someone was asking specifically about Citizens. What are you seeing for increases in Citizens wind policies for South Florida condos?
If you're getting a renewal from Citizens, it's not going to be more than 20% in most cases. So their increases are controlled by the legislature. It's just trying to get a policy from them on a new business basis can be very, very difficult. You've got to have all the underwriting complete or you will not pass. And it is common now, we're seeing them cancel buildings that they've accepted. Last year it had 3 years of useful life left, and this year they're canceling it. And I've had some that have agreed to replace the roof. We've shown them a contract and a path to do it, and they still won't rescind the notice. So they're getting tough.
Right. Marcia asked about statute 720. Yeah, I will say most of what we covered today was heavily related to condos. That's because the condo insurance is just such a massive percentage of their budget, 40, 50, 60% in some cases now. The HOAs get off a lot easier on the insurance side because you're not insuring the homes, just your common elements and liability. The best advice I can give to you guys in the HOAs is sidewalks. Please look at your sidewalks. Bring out a company to evaluate where you have lifting, cracking, and get those repairs made immediately. As expensive as you think the repairs are when you have an open 6-figure claim for a fall, the increase will probably be more than what the repairs were, and then you're stuck with that increase for multiple years because you have those claims on your renewals. So the people in HOAs, I would look at your liability issues and your safety issues. That's where you can have the most impact on the insurance in your budgets. We covered that, I think, about having a roof report if you can try to extend the useful life of your roof. Someone asked, can you change agents and or companies in mid policy year, I guess would be the question.
Yes, you can. Some carriers will limit the time ahead of the renewal date that they will accept it. But generally speaking, the association is in control of who they want the agent to be.
Right. Someone asked, can the agent be given the agent of record letter for a specific company?
Yes, you can do that. You can give an agent of record for a specific company. There are just so few companies that are out there right now that if an agent is out there trying to build that tower that we talked about, and now there's a limitation as to where he or she can go, and you've got 2 agents that are in the market, you're probably as a consumer not going to benefit from that. you think you're creating competition, but you're limiting an agent to go out there and try and piece this thing together the best he or she can do for you.
All right. So Donald asked, are all the categories of insurance kind of going up at the same pace, or is the property insurance piece outpacing the other increases?
The property is outpacing most of the other, I would say, liability, maybe general liability, for the reasons you mentioned, Evan. Slip and falls is probably, close to keeping pace. And then umbrella could be a big problem, but unfortunately, the ones that aren't really increasing are the ones that are the smallest premiums, like crime and boiler machinery, equipment breakdown, and those policies really are pretty flat right now.
Okay. This is, I mean, it's kind of a simple question, but I do hear it quite a bit. What is the difference between a broker and an agent?
So a broker will, an agent will represent the carrier and also represent the client, whereas a broker will represent just the client. So that's a different. And most of the time, an agent will say I'm an agent or a broker and not really know the difference. Like, so if we represent both the carrier directly, we're an agent of the insurance company. If I have to go to a market where I need to get through a wholesaler, then I go through a broker that represents that carrier, and that's generally the difference.
How often do I need to do an appraisal?
Every 3 years for a condo. And I would recommend the same for an HOA, even though it's not required by statute.
Right. This is a good question. We didn't address this really, but it's becoming much more of an issue. What about cybersecurity insurance?
Yeah, I'm glad whoever asked that question did, because this is one of those policies that remains really cheap still and provides a lot of value. And there's a lot of ways to get it. I mean, you can put an endorsement on a directors and officers insurance policy and get some coverage for it for as little as $200, $300 a year. You can buy a full-blown policy that covers all of everything. But in simple terms, what that is if there's a data breach, and you are responsible for, or you are alleged to be responsible for a breach of what the government considers PII, personal identifiable information. You could be sued. You could be investigated by regulators. You could be held responsible to monitor people's credit. And also from a first party standpoint, they get your data and they shut it down. What do? Just the response alone is worth the cost of insurance.
Right. Diane asks about flood insurance, that there were some rumors everyone would need to carry flood insurance. I think I recall that was maybe tied to some legislation that ended up not happening. Do you remember what that was about?
Yeah, there was some legislation that didn't gel about you had to buy flood insurance. Some carriers will require it. Not a lot of carriers have relaxed that. But generally, we find communities that are located everybody's in a flood zone, but those that are designated in a high hazard flood zone buy it, and those that aren't in a high hazard flood zone, because the cost of property insurance has just skyrocketed, they're not buying it.
Right. You had mentioned earlier that a high rate of rentals could cause you to be declined. What is approximately the number that you see where it starts to become concerning for a carrier?
Some carriers, your preferred markets, will start to raise an eyebrow if it's over 20-25%. And then I would say anything that's over 30 to 40% is definitely in the high range.
All right. Terrorism insurance, do we need it?
I mean, do you need it? Yeah. I mean, the world's kind of a crazy place right now. Basically, TRIA was created after 9/11, and it was basically a federal backstop where carriers that put an exclusion on, every carrier put an exclusion on their policy. Similarly, what we saw after COVID, where you've got all these communicable disease exclusions on there. So in some cases, it's very, very affordable. And my advice would be, they have to disclose it. It's on all the forms. So see what the cost is. And in some cases with non-admitted carriers, it can be very costly. Weigh the cost versus the risk and make a decision.
Um, combining two of my favorite topics, liability insurance and ESA animals. Um, do the animal bite exclusions and do animal bite lawsuits still apply when you have ESAs? I know the answer, but
Sure,
I
they
mean,
sure
absolutely.
do.
It doesn't matter if it's an ESA or not. The exclusion is going to exist, and if the dog bites somebody, you're going to have a lawsuit. So pretty much every time. Um, let's see. Who determines the roof's useful life? My manufacturer said we had a 50-year roof. Will the insurance company accept that?
An independent third party has to be a licensed roofer or a licensed general contractor will have to go and inspect the roofs. The warranty is for maybe leaking, but these carriers or the manufacturers and the insurance companies have their guidelines on the type of roof and the life, and it's pretty hard and fast on whether or not it doesn't matter what the warranty is. The warranty may be for leaking, but it has a useful life, and there's a difference between a roof that doesn't leak and how a roof will perform when it gets exposed to windstorm.
Right. So I know this is kind of a bit of a range, but what do you see as the average acceptable useful life to the insurance companies these days? How many
Well, it's going
years?
to depend on the type of roof, the type of roof it is. The wood joisted roofs with the tile have a longer lifespan. 20 years versus your flat roofs that bituminum, where those roofs have a lot less useful life to them, 10-15 years.
All right. So this is a good question, and I do want to address it. How can the wind sublimit be allowed if the statute says you have to be fully insured based on appraisal? And the answer is, well, I'll let you answer it. I have some thoughts, but
Well, I mean, it's a great question, but I mean, this is the practicality of this right now. So, I mean, if an association that has a huge insurable value either can acquire it or the number is just a goofy number, I mean, what do you do at that point? I mean, in some cases, we just simply can't get it. It's just so it's not a factor. But if the number is $5 million and the assessment is, we just you can't get it, practically speaking.
right. Yeah, I would say if you end up in that situation where you are unable to, or it's extremely prohibitively expensive to purchase the full limits, you really need to get your association attorney involved at that point, because the statute is clear and so are your documents. But I don't think the statute nor the documents ever anticipated a market like this. So as a director of your association, to make sure you're covering yourself, I would absolutely involve your association attorney once you find yourself in that position. And they'll guide you through that. Are the SIRS regulations having any impact on rates, SIRS or milestone inspections?
Huge. A lot of carriers, Dade and Broward have had these inspections. They aren't new to these risks, but in Palm Beach County and North, they're wanting to see them. Some carriers have a underwriting criteria that if you don't have an inspection, even if you're not required to have it yet, they're not going to consider you. And it is, and I can tell you from the standpoint of Citizens, they're going to require these inspections, and if there's any outstanding information, any outstanding work, they're going to want to see proof, documentation that the work was completed. I mean, we're looking at 30-year inspections that are 7-8 years old, and the work has been done. The association can't prove that the work has been done. It's a decline.
Right.
So it has a huge impact, and that's where they look at the electrical and all those components to their underwriting.
Yeah, this is a good question. We didn't cover this policy. What is a difference in conditions policy?
Difference in conditions. So going back to Citizens is going to provide a basic insurance policy, which is basically fire, lightning, and wind, and that's all they're giving us. So the difference in conditions stands for DIC stands for difference in condition, and it's basically a supplemental policy that wraps around that basic policy that Citizens gives us and fills in the gap to make it a real insurance policy.
All right. Well, we're at 5 after, so I don't want to be respectful of everybody's time today. Unfortunately, there's no way just to get to all the questions that get asked. We had a lot of people on with us. So thank you all for attending. I greatly appreciate it. I know Paul does as well. And if you want to see information about future webinars that Campbell is hosting, you can go to campbellevents.org. That's campbellevents.org. And there you'll be able to see all of our past webinars and look up topics that interest you and register for future ones. Anything else left to say today, Paul?
Just in closing, I greatly appreciate being here. Hopefully we gave everybody some useful information. And my associate Chad Tiernan may reach out to you. We're not looking for any obligation. If we can help navigate or give somebody a second opinion out there, because we know this, we're happy to do so.
Thank you, Paul. Thank you, everyone who attended. Hope to see you on some future webinars. Have a good afternoon.
Thank you, Evan.
Thanks for watching. For more great educational content, click the subscribe button now.